Whether you're a first-time homebuyer or a seasoned homeowner, understanding the differences between loans can help you make an informed decision. VA loans are designed for veterans, active duty service members, and their families. Now, these loans are backed by the Department of Veterans Affairs and offer many benefits, such as requiring no down payment, which is a big one, no mortgage insurance, and they have a competitive interest rates compared to other types of loans. Now, keep in mind they require something called a VA funding fee, which is a one-time payment that the borrower pays along with their other closing costs. This fee helps lower the cost of the loan for U.S. taxpayers since the VA home loan program doesn't require down payments or monthly mortgage insurance. However, there are exemptions, so be sure to ask your lender. Now, the amount you'll pay depends on a myriad of factors, so be sure to ask your lender, but essentially it will be a percentage of loan of the amount you borrow. So a conventional mortgage loan, for example, let's talk about conventional mortgage, is a conforming loan that simply means that it meets requirements for Fannie Mae or Freddie Mac. Now, Fannie Mae and Freddie Mac are government-sponsored enterprises that purchase mortgages from lenders and sell them to investors. You don't really know all that, but now you do. This frees up lenders' funds so they can go get more qualified buyers into homes. Now, because there are several different sets of guidelines that fall under the umbrella of conventional loans, there's no single set of requirements for borrowers. However, in general, conventional loans are going to have stricter credit requirements than government-backed loans like FHA loans, and it's possible for first-time home buyers to get a conventional mortgage with a down payment as low as 3%. However, the down payment requirement can vary based on your personal situation and the type of loan or property for which you're trying to get. So, if you're not a first-time home buyer or making no more than 80% of the median income in your area, the down payment required is 5%. If the house you're buying is not a single-family home, it has more than one unit, like a duplex or triplex, you may need to put down 15%. If you're buying a second home, you need to put down at least 10%. Now, if you're getting an adjustable rate mortgage or an ARM, the minimum down payment is 5%. If you put down less than 20% on a conventional loan, you'll be required to pay for private mortgage insurance or PMI. Now, PMI protects your mortgage investors in case you default on the loan. The cost for PMI varies on your loan type and your credit score and the size of your down payment. Now, PMI is usually paid as part of your monthly mortgage payment, but there are other ways to cover the costs as well. Now, some buyers pay it as an upfront fee included in their closing costs, and others pay it in the form of a slightly higher interest rate. Choosing how to pay for PMI is a matter of running the numbers to figure out which option is cheapest for you. So the nice thing about PMI is that it won't be part of your loan forever. That is, you won't have to refinance to get rid of it. When you reach 20% equity in your home on your regular mortgage payment schedule, you can ask your lender to remove the PMI from your mortgage payments. Now, you may have to get your home appraised again. If you reach 20% equity as a result of your home increasing in value, you can contact your lender for a new appraisal so they can use that new value to recalculate your PMI requirement as well. So once you reach 22% equity in your home, your lender will automatically remove PMI from your loan. In most cases, you need a credit score of at least 620 to qualify for a conventional loan, and your back-end DTI should be below 45%, although this depends on your specific situation once again, so be sure to check with your lender. Now, interest rates for conventional mortgages change daily. Conventional mortgage interest rates are usually slightly higher than FHA loan rates, but they're slightly lower than FHA loan, but slightly higher than VA loan. However, the actual interest rate you'll get will be based on your personal situation. So while sites can give you an estimated conventional loan interest rate, the best way is to see which rate for which you qualify is to talk to a lender. So conventional loans generally offer lower costs than other types of loans, and if you meet the credit score requirements and you want a down payment as low as 3%, a conventional loan mortgage might be the best solution for you. Now let's talk about FHA loans. Now, FHA loans are backed by the Federal Housing Administration and are designed to help low and moderate income borrowers. Now, these loans require a lower down payment than conventional loans, and borrowers can have lower credit scores and higher debt to income ratios. Assuming you're putting less than 20% down, there's an upfront mortgage insurance premium or MIP payment you'll pay at closing. That's about 1.75% of the purchase price, and an annual MIP, which is divided up and added to your monthly mortgage payment. Now, your monthly MIP costs will vary depending on the amount of the loan, the size of your down payment, and the length of your repayment term. If you put less than 10% down on your FHA loan, you'll have to pay your MIP for the life of the loan, regardless of how much equity you have, something to keep in mind. Now, the minimum down payment you're able to make on an FHA loan is directly linked to your credit score. So you may qualify for an FHA loan if you have debt or a lower credit score, and you might even be able to get an FHA loan with a bankruptcy or other financial issue on your record. Now, the option of a low down payment and more lenient credit requirements can make FHA loans particularly attractive for first-time home buyers, but you don't have to be a first-time home buyer to qualify. Another perk of FHA loans is that your closing costs can often be rolled into your loan, which is known as a no closing cost mortgage. Now, of course, there's a downside. You've got to pay interest on your closing costs, which means it will likely be more expensive in the long run. So if you won't be utilizing this option, the general rule of thumb is to plan on having between 3 and 6% in cash of your total loan amount on hand for your closing costs. Now, you may be able to negotiate for the seller to pay some of these closing costs, but the FHA does limit seller concessions to 6% of the purchase price. Now, are you looking to build wealth by becoming a landlord? The FHA defines a single family home as any home with 1 to 4 units. Therefore, you could actually use an FHA loan to purchase a multi-unit single family home as long as you occupy one of the units for a minimum of the year, so like a fourplex. Now, lastly, we have USDA loans, which are backed by the U.S. Department of Agriculture. Now, these loans are designed to help borrowers in rural areas with low to moderate incomes. And believe it or not, 90% of Americans live in what are considered rural areas by the government. I didn't know that. So the USDA loans require no down payment, and they offer low interest rates as well as 100% financing. Now, in order to be approved for a USDA loan, you and the property must qualify. The area in which the property is located must have a population of less than 20,000, and in order to meet the income qualifications, you must make less than 15% above the average income for the area. You must also be able to demonstrate that you have stable income over the past 24 months, and you cannot have any debt set to collections within the past year. A credit score of 640 will be required by most lenders, and your DTI ratio should be below 41%. You'll also be required to purchase private mortgage insurance, once again, the PMI we talked about. And finally, your monthly payment must not exceed 29% of your monthly income. So in summary, VA loans are for veterans and service members, conventional loans are offered by private lenders, and FHA loans are designed for low and moderate income borrowers, and USDA loans are for borrowers in rural areas. Now, each loan has its own requirements and benefits, so it's important to speak to a lender to determine which loan best suits your needs.